If you've been following financial news lately, you might be confused. Earlier this year, headlines were screaming about the dollar's historic collapse. The US dollar experienced its steepest decline in over 50 years during the first half of 2025, plummeting nearly 11% against major currencies. But here's the twist: the dollar is bouncing back, and understanding why tells us a fascinating story about global economics, investor psychology, and what might happen next. I'm going to break down exactly what's happening with the dollar, why it matters to you even if you never travel abroad, and what the future might hold. Let's dive in. To understand where we are, we need to look at where we've been. From 2010 to 2024, the US dollar was on an incredible run, gaining about 40% over 15 years. It was a structural bull market that seemed unstoppable. Then came 2025. Between January and June, the dollar collapsed. We're talking about the biggest six-month loss since 1973. The dollar index, which measures the greenback against a basket of major currencies, fell over 10%. Several factors converged to create this perfect storm. First, policy uncertainty. The Trump administration's second term brought inconsistent policy rollouts and regulatory reversals. Investors hate uncertainty, and they started pulling money out of dollar-denominated assets. In fact, a Bank of America survey showed global fund managers at their lowest dollar allocation since 2005. Second, the tariff situation. New tariff policies created concerns about economic growth. When tariffs were announced, growth forecasts for the US dropped from 2.3% to 1.4% in just 2 months. These policies raised questions about inflation, trade relationships, and economic stability. Third, interest rate convergence. The Federal Reserve began cutting rates while maintaining relatively high levels compared to historical norms. But here's the thing: other central banks were maintaining their rates or cutting less aggressively. This narrowed the interest rate differential, which is a key driver of currency strength. Fourth, capital reaction. After years of exceptional US stock market returns, European investors started bringing money home. European-focused ETFs saw record inflows of $42 billion, while flows into US equities dropped significantly. And finally, fiscal concerns. The federal budget situation worsened, with debt projected to reach 122% of GDP. Investors started questioning the sustainability of US fiscal policy. But something interesting happened. Starting in late summer, the dollar stopped falling and began to stabilize. By November 2025, the dollar index was trading around 100, having recovered from its lows. What changed? Despite all the doom and gloom, the US economy proved remarkably resilient. GDP data came in better than expected. Job creation, while modest, continued. Consumer spending held up. The US economy was simply outperforming expectations and, critically, outperforming other major economies. Europe was struggling with weak growth. Japan continued to face long-term structural challenges. China's economy was losing momentum. As one economist put it, the US economy is doing very well, and the rest of the world is floundering. While the Fed did cut rates, it didn't cut as aggressively as many expected. Meanwhile, other central banks were forced to cut more deeply. The gap between US 10-year bond yields and those of major partners reached its widest level since 1994. This matters because investors chase returns. If you can get a higher, safer return on US bonds than on European or Japanese bonds, money flows to the US, and when money flows into the US, demand for dollars increases, pushing up its value. Despite earlier concerns, the dollar's status as a safe haven currency reasserted itself. When global uncertainties arise, whether it's geopolitical tensions, market volatility, or economic concerns, investors still turn to the dollar. The dollar remains the world's primary reserve currency, accounting for about 58% of global foreign exchange reserves. There simply isn't a viable alternative. The euro has its own problems with European political fragmentation. The yuan isn't freely tradable. Gold doesn't pay interest. The dollar, despite its challenges, remains the most trusted major currency. With US interest rates higher than most developed markets, carry trades became attractive again. This is where investors borrow in low-yielding currencies like the yen or euro and invest in high-yielding US assets. This creates sustained demand for dollars. Let me break down what actually drives currency values, because this helps us understand not just what happened, but what might happen next. Interest rates and monetary policy is perhaps the most important factor. When a country raises interest rates, its currency typically strengthens because investors can earn higher returns. When rates fall, the currency usually weakens. But it's not just about absolute rates. It's about relative rates compared to other countries. Strong economic growth attracts investment. If the US economy is growing faster than Europe or Japan, investors want exposure to US assets, which requires buying dollars. Right now, US growth expectations remain relatively strong compared to other developed markets. Money constantly moves around the world seeking the best returns. For years, the US stock market outperformed everyone else. drawing massive capital inflows. When those flows reverse, even slightly, it impacts the dollar. But as long as US assets remain attractive, the dollar has underlying support. High inflation erodes a currency's value over time. While US inflation has been sticky and concerning, it's been relatively controlled compared to some other regions. This helps maintain confidence in the dollar's purchasing power. Here's where it gets really interesting. Forecasts are deeply divided. Some major investment banks predict continued weakness. Morgan Stanley expects another 10% decline by late 2026. JP Morgan turned bearish on the dollar for the first time in 4 years, predicting it will weaken as US growth moderates and converges with other economies. But other analysts see continued strength. The dollar could trade in a range between 98 and 102 on the dollar index for the near term, with potential for a meaningful rally if certain conditions emerge, like a significant market shock that triggers safe haven demand, or if Fed rate cuts pause while other central banks continue easing. There are key variables to watch. Will the Federal Reserve cut rates aggressively or maintain a higher for longer stance? Does the economy continue to outperform, or does growth slow meaningfully? Do threatened tariffs materialize? And if so, what's the economic impact? Do global tensions increase, driving safe haven flows? Does the US address its deficit concerns, or do they worsen? Even if you never exchange currency, the dollar's value affects you. If you're a consumer, a stronger dollar makes imports cheaper. That German car, that Japanese electronics, that French wine, all become more affordable. But it also means American exports become more expensive for foreigners, which can hurt us manufacturing and jobs. If you're an investor, a strong dollar reduces returns on international investments when converted back to dollars. If you own international stocks or bonds, currency movements can significantly impact your returns. However, it also means foreign goods and assets are cheaper to buy. If you work for a multinational company, a strong dollar can hurt earnings from foreign operations. When companies convert foreign sales back to dollars, they get less. Many S&P 500 companies derive significant revenue from abroad, so dollar strength can impact stock prices. If you're planning to travel, a stronger dollar means your money goes further abroad. That European vacation becomes more affordable. So why is the dollar getting stronger again? It's not just one thing. It's a combination of US economic resilience, attractive interest rate differentials, its enduring safe haven status, and the simple fact that alternatives remain limited. The dramatic decline in early 2025 was real and historic, driven by policy uncertainty, tariff concerns, and capital but the underlying strengths that made the dollar dominant, a large, innovative economy, deep financial markets, political stability relative to alternatives, and the lack of a credible alternative reserve currency, haven't disappeared. Here's the paradox. The dollar is simultaneously overvalued by many traditional metrics, facing serious structural challenges from fiscal deficits and political uncertainty, yet still fundamentally strong because everything is relative in currency markets. The dollar doesn't need to be perfect, it just needs to be better than the alternatives. What should you watch? Keep an eye on Fed communications about future rate cuts. Monitor economic data, especially relative to other major economies. Pay attention to tariff policy developments, and watch for any signs of major capital flow shifts. That currency markets are telling us a story about global economic power, investor confidence, and the future of international finance. The dollar's recent recovery isn't necessarily the start of a new bull market, but it's a reminder that in the world of currencies, fundamentals eventually reassert themselves. Will the dollar continue strengthening? That depends on whether US economic outperformance continues, whether the Fed maintains its policy advantage, and whether global uncertainties drive safe haven demand. The consensus seems to be that we're in for a period of volatility and uncertainty, with the balance of forces keeping the dollar in a relatively tight range. One thing is certain. The dollar's role in the global economy means its movements ripple through everything, from your grocery bill to your investment portfolio to global trade patterns. Understanding these dynamics isn't just academic, it's essential for navigating an increasingly interconnected world. Thanks for watching. If you found this helpful, let me know in the comments what aspect of currency markets you'd like me to explore next. Should we dive deeper into how this affects emerging markets? Or look at what would need to happen for the euro or yuan to challenge dollar dominance? Let me know. Until next time, keep learning, keep questioning, and remember, in economics, everything is connected.